Learn the only rule you need to beat the stock market and get rich. Most people find the stock market too complicated and risky. However, you can make money by following Warren Buffett's strategy. Find a great business, figure out its value, buy its stock for half that value, and repeat. On this episode, we will learn how to identify such businesses, understand market inefficiencies, and why a diverse portfolio isn't a guaranteed solution. Lesson number 1. Contrary to popular myths, you don't have to be an expert to be a great investor, and it is possible to beat the market. You don't need a financial expert to invest successfully. Managing money doesn't require extensive knowledge or professional tricks. The internet provides affordable tools and information, like stock histories and calculators on different websites. Technology has made these tools more accurate than expert advice a decade ago. Contrary to the efficient market theory, which says you can't beat the market, history proves otherwise. The 90s bubble and Warren Buffett's success demonstrate that stock prices can be mispriced. Forget the myths about needing experts or an unbeatable market. With internet tools and these strategies, you can make successful investments on your own. Lesson number 2. The popular strategy, diversify and hold, is not nearly as safe as it's cracked up to be. Instead of just spreading your investments out and holding on to them, consider a smarter approach. Diversifying and holding might sound safe, but it doesn't always work. In fact, this strategy would have failed for more than half of the last century. Between 1905 and 2005, a diversified portfolio would have had zero returns for 60 out of 100 years. So, instead of blindly diversifying, keep a close eye on your stocks. It's tough to monitor a diverse portfolio, and you might not fully understand the businesses you're investing in. For example, if you work in healthcare and receive a warning letter about a drug's side effects, you can act quickly to avoid losses in pharmaceutical stocks. But if your investments are spread across various industries, you might miss crucial information and suffer losses. Remember, if the market goes down, so does your diversified portfolio. Be cautious, especially when large sums are withdrawn, as it can trigger a chain reaction of declining values in mutual funds. This risk increases when a significant number of investors, like baby boomers, withdraw money for retirement. Lesson number 3. Only invest in a business you understand and you'd like to own. Now, if you're thinking about buying a business instead of stocks, would your criteria change? Smart investors choose companies they'd want to own for the long term. So, when buying stocks, treat it like buying the whole company to make careful investment decisions. Buying stocks might seem easy to exit quickly if the company performs poorly. This could lead to risky choices, focusing too much on one growth aspect or losing money in a market bubble. However, if you consider buying the entire company, you'd be more cautious. You'd analyze its performance, history, and management against other companies, leading to better decisions. For even better investment decisions, it's wise to invest in a sector you're familiar with. If you work in IT, you're in a better position to invest there because you understand the providers, their strategies, and product quality. Remember, investing in a business is like voting for it to continue its work. Consider the impact of your investment, especially if you're funding your child's education with profits from a company exploiting children in a third world country. As an investor, you probably wouldn't support that. Your investment choices make a statement about where you choose to invest. Lesson number 4. There are good criteria for a company's ability to stand its ground. Think of a company's assets like a protective barrier around a castle. These assets help the company stay strong against competition and rising prices. When you invest, it's smart to pick companies with these protective moats. So, what do these moats actually do? They help a company rule its market, increase prices to match inflation, and make enough profit to grow. There are different types of moats. Some are intangible advantages, like patents or secrets that make it tough for others to compete. Pfizer's patent for Viagra kept others from copying it, giving Pfizer a monopoly. Another type of moat is a strong brand that customers love. Coca-Cola's powerful brand makes people choose its drinks over others. A moat can also mean having cheaper or more accessible products. Walmart, being huge, can bargain with suppliers and sell things at competitive prices. Sometimes, a moat is when a product is not cheap, but it's a hassle to switch. Like Windows, people may not like it, but they stick with it because changing means changing all their software. Lastly, some companies have a moat because they legally control a market. For example, the Pacific Gas and Electric Company has a legal monopoly to provide power in its area. Lesson number 5. Steady businesses have competitive advantages. To know if a company has a strong position in the market, look for 5 indicators consistently over 10 years. First, check the return on investment capital for at least a decade. Return on investment capital is the profit a company makes from its investments. If a company maintains a return on investment capital of at least 10% for 10 years, it likely has a strong position. Next, assess the growth of a company's equity. If the equity increases by 10% or more for 10 years, it indicates the company has enough money for expansion and is in a competitive position. Stay tuned for the final 3 indicators in the next section. Lesson number 6. Some competitive advantages are easy to spot. To check if a company has a strong position, you can use 3 simple calculations. 1. Earnings growth. Look at the company's earnings per share. If it consistently increases by at least 10% over 10 years, it's a good sign. For instance, if a restaurant's earnings per share goes from $20,000 to $160,000 in a decade, and you find it doubles around every 3 years, the company has a 24% growth rate, indicating a strong position. 2. Sales growth. Check if the sales consistently grow over 10%. For example, if a company's sales double 3 times in 9 years, it has a 24% growth rate, suggesting a solid position. 3. Free cash flow growth. Examine if the free cash flow growth rate is consistently over 10%. This means the company is turning profits into cash for expansion. If a company's free cash flow doubles almost twice in 7 years, giving an 18% growth rate, it indicates profitability. Lesson number 7. For an investor, a company is only promising if the CEO is driven and owner-oriented. When picking a company to invest in, consider the Big 5 criteria in the charts, but also focus on the CEO. Choose an owner-oriented CEO who makes wise long-term decisions and keeps shareholders informed. A good CEO admits to problems, provides explanations for bad years, and avoids actions that boost stock prices temporarily but harm the company in the long run. Avoid executives who only care about short-term gains and not the company's future. Look for a driven CEO who sets ambitious goals, motivating employees to achieve them. A company led by such a manager is likely to increase in value, benefiting your investment. For example, Darwin Smith transformed Kimberly-Clark into the world's top paper-based consumer products company over 25 years by being driven and visionary. Knowing if a CEO is honest and motivated helps you accurately assess a company's value. Lesson number 8. Demand a big margin of safety. Simply put, the effective market theory is wrong because price and value are not the same. You should buy stocks when there's an advantage, considering that price is what you pay, and value is based on a business's earnings. To assess stock value, use tools like sticker price calculators online. Markets can be wrong in the short term. Smart investors buy stocks cheaply when there's a difference between price and real value. Demand a large margin of safety, which is the value minus the price. A good margin of safety is half the value of an investment. For instance, if a stock's real value is $40 per share, its price should be no higher than $20 for an investor. This approach prevents losses in a bubble. In 2000, every crashed NASDAQ stock had a price higher than its value. So, in summary, the internet provides easy access to tools and stock information for smart investing. With basic calculations and the ability to identify successful companies, you can make informed investment choices and grow your wealth. Thank you for watching. Don't forget to like, comment, and subscribe. Watch more videos by clicking on this video right over here.